Get started here. Hi, everyone. My name is John Sloan. I am Keller Williams agent here in La Quinta. And the reason why I decided to put this together is because I have a couple of individuals who are doing 1031 exchanges. One of them was a little bit unusual. The other one was pretty standard. But I thought, hey, you know what? This is a good opportunity to reach out to someone who is basically into the 1031 exchange scenario. And so I reached out to Stephanie Kelsey. Stephanie is the Southern California Division Manager for Asset Preservation. Yes, right behind her. And we've had a number of conversations about my situation. And I decided that it would be a good idea to share this information with everybody else. What I'm seeing is that approximately 10% of the purchases that are being done here in the US are 1031 exchanges. And I know you guys are in markets where you've got a number of Airbnbs, and with Airbnbs kind of taking a little bit of a hit on their rentals, there's going to be more sales taking place. And so I thought, well, let's get somebody in here who could talk about the 1031 exchange, because there's a variety of things with respect to 1031 exchanges that are a little bit different. So I want to introduce Stephanie Kelsey. As I said, she is the Southern California Division Manager for Asset Preservation. So Stephanie, tell us just a little bit about yourself, and then we'll get rocking on the program itself.
Sure. Okay. So again, my name is Stephanie Kelsey, Division Manager for Southern California with Asset Preservation. I started out in residential real estate. After a couple of years, I moved into the commercial arena. And then I was a sourcing broker for DST portfolios. So I was looking at retail net lease properties and things like that and learning how to review them. After that, I went and got some securities licenses so I could work directly with the 1031 exchange investors, helping them get into DST portfolios or find their own retail net lease properties. I also helped them list their residential income or their retail net lease type of properties as well. And then started looking for something new, and this opportunity presented itself, and I was really excited about it. And oddly enough, I really like teaching tax code now. So I've been with Asset Preservation since January of this year, but I've been in the 1031 exchange arena. I have my securities licenses, and so I'm very familiar with the 1031 exchange tax code and lots of the different nuances that go along with it.
Wonderful. Okay, there will be an opportunity to ask questions once Stephanie's finished with her presentation. So have at it, Stephanie. Thank you.
Okay, can I go ahead and share my screen?
You got it.
Great. And John and, okay, good. I'm on the right one. Let's see, am I doing that right? Do I just close this now? Share. Okay. John, I just really want to thank you so much for having me here today. And okay, this is on the wrong screen. I'm going to move my camera so that I'm looking at y'all while I'm doing this. Okay, so again, as I told you, Stephanie Kelsey with Asset Preservation. A little bit about our company, Asset Preservation, or API. We are a leading national qualified intermediary. We're also referred to as exchange accommodators. It's a little bit easier to pronounce than qualified intermediary. And we have facilitated over 200,000 exchanges while we've been here, and we have been in business since 1990, so well over 30 years. We are one of the largest qualified intermediaries in the United States. So we're not just an accommodator, but we're also an educator. So like I'm doing here today, I would go out to brokers' offices, title companies, accountant offices, CPAs, things like that. And we teach them about the tax code because it can be very nuanced, and we just want to make sure everybody has a really good understanding about it. We are a member in good standing with the Federation of Exchange Accommodators, which is very important. Most people don't realize that the industry of the qualified intermediaries, we're an unregulated industry. So you really do want to make sure when you're recommending a QI to your clients, or if you are the client, if you're looking at QIs, that you make sure that they've got a long history, that they've got good standing, because again, we're unregulated, and there have been some times where there have been some shady characters who have acted as QIs, and things have not gone so well for their investors. They're thinking, oh, I want to save a little money, I can do this for less. But you really want to vet your QI and make sure that it's a safe place to park that cash while it's being held for your 1031 exchange. Also, we have a large subsidiary who backs us, Stewart Information Services, and they are a publicly traded company. Okay, so what we're going to be covering today, we're going to be going over the Section 1031. It's a tax deferral on the sale of a property used in a trade or business or held for investment when exchanged for like-kind replacement property. We're going to go over what that means, exactly what like-kind is in a little bit. We're also going to go over capital gains taxes. There's 4 different sections of that we need to be aware of. Also, what are exchange entities and why is that important? We're going to discuss what like-kind property is, because it can get confusing lots of times. We're going to go over Delaware statutory trusts. It's an alternative vehicle for 1031 exchange investors. It can be used as their main option, or it's also a very good backup if they're concerned they're not going to be able to find a good replacement property. We're going to go over how you can take a vacation home and be able to do a 1031 exchange tax deferral for vacation homes. There are very specific guidelines that allow that to happen. We're going to let people know what the holding period is. There's a lot of misconceptions about that. We're also going to go over a regular delayed exchange and what a reverse exchange is, and we're going to cover identification rules. Okay, so when an investor has a property, they've got 3 different options that they can approach what they're going to do with it. They can choose to hold it and see what the market's doing, wait till the best time to either decide to sell or, keep it a little bit longer. Now, if they decide to sell the property outright and then pay the taxes on that and cash out, if they're planning on reinvesting those funds, they're not going to get the same return on their investment once they've paid out their taxes to the federal government and state government and all that thing. If they do the 1031 exchange, they are able to defer all capital gains taxes with a fully deferred 1031 exchange. Or if they choose to do a partial exchange, meaning say they needed to reinvest 500,000, they only decided to reinvest 400,000, that extra 100,000 that they did not reinvest would be referred to as boot. And that amount would be subject to capital gains taxes, which currently are about 37%. Once you take into consideration depreciation recapture, federal, state, and then there's an additional one that I'll get into shortly. But so the 1031 exchange is a very important tool because it allows them to reinvest that equity that would have been used to pay capital gains taxes, and they can use all of those funds towards the purchase of a replacement property. What are some of the reasons they might want to sell their property and do a 1031 exchange? What's the reason for moving forward and getting rid of your property? Well, if you're going to sell your property and you want to diversify your either asset or geographic location, you can say you're only having single family residences and you're not too sure about the market. You're able to go into other different types of asset classes like retail or multifamily or even land possibly. And then geographic, some people are looking at the California market as maybe not the best place to be right now. So they're going to look at other places like maybe Texas, Florida, North Carolina, South Carolina, Tennessee. Some people want to have a different diversification for asset class or geographic. Leverage, if they're going to sell one property, they can then take that one property and possibly buy 2 or 3 properties to expand their return on investment that they currently have. There's also the opposite. Maybe they have 3 single family residences and they just want to consolidate everything to make it more simple. So say they sell 2 or 3 single family residences and decide to buy like a CVS where they're just having to manage one property. cash flow, again, that's one of the main reasons they want to increase their return on investment. And lots of times selling, deferring taxes, and going into a new investment will allow that. Management relief. Again, if you're owning like a single family residence, you're dealing with tenants, termites, and trash. They're kind of tired of that. They'd like to go into a retail net lease property or maybe go into an alternative such as a DST portfolio. And then there's estate planning purposes. They're going to be looking forward about what's going to happen with this property when I pass it on to my heirs. What's my best choice for doing that? So those are some of the motivators behind why people might want to be selling. So selling appreciated property, there's multiple tax codes that go along with the selling of real estate. So first again is the 1031 exchange, which we're focusing on today. Tax deferral on the sale of a property used in a trade or business or held for investment when exchanged for like-kind property. The 1033 exchange is for involuntary conversion or eminent domain. That is not part of a 1031 exchange. It allows people up to 2 years with no real rules where they can reinvest those funds. That's like if the government comes in and takes possession of your land, you'll have 2 years to reinvest those funds. The Section 121 is the one that we're most familiar with, which is for primary residence, where there's that tax exclusion of $250,000 for a single person or $500,000 for a married couple filing jointly. And then there's the 721 tax deferral. That's something that comes later after a 1031. And I'll talk about how a 1031 exchange investor can go from owning real property and then eventually land into a REIT if that's what they're looking to do. And a REIT is a real estate investment trust. There needs to be a step of a 1031 exchange to get there, and I'll go over how that works. Okay, so 1031 exchanges have been around for quite a while. They've been around since 1921. They seem to be gaining popularity recently as more people are starting to catch on to what an important tool this is for them to basically reinvest all of those funds to expand their portfolios. Okay, so this is one of the things that's very important. We want to understand what capital gains taxation is. So 20% of capital gains tax for higher earners. Oh, something seems to be missing here. Hold on. Okay, I don't know what happened. Oh, there we go. Sorry, I apologize. So yeah, it's going to be about 20% capital gains tax rate for higher earners and 3.8. That's supposed to be in a different thing. I apologize. So capital gains taxation down here includes 4 components. First off, they're going to have the taxation on the depreciation recapture, and that's at a rate of 25%. Then you've got your federal gains tax, 20% or 15%, usually 20% for the higher earners. Then there's a 3.8% tax. That's a net investment income tax. That is part of the Affordable Care Act. And then you've also got California state taxes, which have increased this year to 14.4%. So when you look at all those together, it usually comes out to about 37% tax on those capital gains. Okay, so let's talk a little bit about a sale versus an exchange and why the 1031 tax code is such an important tool. So if you look at this and assume that a married couple is filing jointly and they're going to sell their property in California for $1 million. They purchased this property for $400,000. During that time, they've fully depreciated the property. So 75% of the investment property is depreciated over the 27.5 years. That's for residential, and it's 39 years for commercial. So the capital gains tax now is approximately $900,000. Okay. There are 4 levels again of potential taxation. So the depreciation recapture, federal gains tax, net investment income, and your state taxes. The married couple will be at the 20% tax rate and 3.8 net investment income tax and California taxes. So let's look at what that means here. So we're going to take this $1 million and then the depreciation recapture, because they depreciated from 400,000. They've done 75% of that. So there's 300,000 is depreciated. 25% of that is going to be $75,000. Then you're going to have the remaining $600,000 that's going to have the federal capital gain tax at 20%, which is 120,000. Your net investment income tax at 3.8 is going to be 34. And we're just leaving at 13.3, which is what it was last year, 119,000. So the taxes they're going to owe for that $1 million property are $348,900. So as you're going to see, the amount that they're going to have to reinvest after taxes is going to be $651,000. That's quite a chunk. Most people would like to avoid that if they can. And luckily with the 1031 exchange, they can go ahead and defer those taxes. It's not a complete avoidance. Again, this is a deferral. So they're going to defer that so that they're able to reinvest that full $1 million back into a replacement property. And you can see what a difference that makes if they're going to be, doing a replacement property and they're going to be having the 75% LTV. You can see what they can invest. They're going to have, with the regular sale and cash out, they'd have 2.6 that they could reinvest into replacement property. Whereas if they did the 1031 exchange, they have 4 million that they can replace with leveraging with the 75% LTV. I'm sorry, this is just weird the way this does this. Okay, so what the code actually says, the main gist of the code: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Basically, it's investment property for investment property. And when they're talking about productive use in a trade or business, that could be like, say you're a dentist and you own your own dental office. That property can be 1031 exchange because you're using it for productive use in your trade or your business. Just want to make sure people understand that that's also something that's allowable with the 1031 exchange tax code. Now, these are some exceptions. Stocks in trade or other property held for sale are not allowed for the 1031 exchange. Stocks, bonds, or notes are not allowed for 1031 exchange. Other securities or interests in a partnership, and certificates of trust or beneficial interest. Now, interest in a partnership, if it's a partnership, the partnership can do a 1031 exchange as a whole, but they can't break out of that partnership and do it separately because they're holding an interest in the partnership. However, if they're a tenants in common and there are undivided interests held, then they are allowed to go their separate ways and do a 1031 exchange. But if they hold interest in a partnership together, the entire partnership can do a 1031, but the separate interests on their own cannot. And if you ever have any questions about that, you are free to call me and I can talk to you or your clients about that further. Now, one of the most important things is 1031 exchange is a tax code that is created for the taxpayer. So we want to make sure that the exchange entity is the taxpayer that's selling the property as well as the taxpayer that's purchasing the replacement property. So you want to make sure that you've got the correct entity, exchange entity, on title and on your exchange documents so that it's clear to the IRS who is doing the exchange and that the actual taxpayer is the one doing the exchange. Here are some examples of that. The wife relinquishes property, the wife acquires the property. Now, if it's in a community property state, such as California, Nevada, New Mexico, some of the others, then that counts for the husband and wife as well. But there are other states where it would just be the wife and the wife, or the husband and the husband. The LLC relinquishes, the LLC acquires. As you can see, it goes for corporations. The partnership, you can see the full partnership acquires. So that's just one thing we're making sure. The key issue, again, at the bottom, the tax owner of the relinquished property must acquire the tax ownership of the replacement property. Like kind property. Okay. So as you can see, there's a bunch of different types of properties and asset classes here. All of these count as like kind properties, and you can go from land to industrial, to commercial, to retail. You can acquire mineral rights, things like that. So like kind property just means, again, property that's being held for productive use in a trade, business, or for investment. So you don't have to go from an apartment to an apartment or a retail to a retail. So that's one of the misconceptions. So that really helps a lot of people when they understand what they can look for going forward when they're going to sell their property. Now, some like kind property that is excluded. The principal residence is not allowable for a 1031 exchange. Again, that goes back to the tax code 121, where they have that exemption of 250 or 500,000. And flips do not count either. Those are seen as inventory by the IRS. So what you want to do is make sure that to qualify a property, it has to be an investment property that's being held for investment purposes, not for the purpose of resale. Vacation homes. So you can have a vacation home or an Airbnb that you can use once in a while, but there are very specific guidelines to make it allowable for a 1031 exchange. So what it does essentially is it creates a safe harbor for vacation home exchanges. The IRS will consider a dwelling unit held for investment if certain requirements are met. So the relinquished property and the replacement properties are owned by the taxpayer for at least 24 months. So they need to hold it for 2 years on either side. When they sell it, they had to have held it for 2 years. And going forward, if they're planning on selling it again, they would have had to have that for 2 years. And then also been within the guidelines that I'm going to discuss next. Within each of those 12-month periods, they must rent the property to another person at fair market value for 14 days minimum, so minimum of 2 weeks. And their personal use cannot exceed 14 days, 2 weeks, or 10% of the percentage it was rented out. So if they rented the property out for 250 days, they would be able to then stay there for 25 days. So it's the greater of the two. If it's, they haven't rented it out for beyond 140 days, then they'll be stuck with that 14 days. But if they did 200 days, they can use the property for 20 days. Now, the only exceptions to that are, say there's a leak in the basement and it floods, and the owner needs to go there and do repairs, and they need to let plumbers in, things like that. That is not included in their allowable time for vacation, because they're not really vacationing, they're maintaining their property. So that can be excluded, but they need to be able to prove comfortably with their CPA that they were there for the purposes of repair. So there would want to be like receipts from Home Depot and plumber repairs and things like that. But that makes it allowable if they need to be there longer. Those repair times or maintenance times or painting or fixing windows, those are not included in that amount of time that they can actually use it for vacation. So fractional ownership, or DST. A DST, called a Delaware Statutory Trust, is something, it's only called Delaware Statutory Trust because it was first done in Delaware. Has nothing else to do with Delaware beyond that. So this is an alternative vehicle for 1031 exchange investors. It's a great option for 1031 investors who just kind of want to get rid of any management. They want to defer their taxes, but they're done with property. They don't want to own anything. They don't want to manage anything. They just want to sit back and get some mailbox money, where they sit back every month. Someone else is managing it. Someone else is seeing to it. And so they can take those funds from their 1031 and they can invest it in something called a DST. The DST is created by a larger sponsor, and that DST can be made up of different things, such as many multifamily properties. It can be 2 or 3 Amazon warehouses. It can be a collection of student housing. It can be a collection of all different asset classes. It might be a collection of investment grade net lease retail properties. So what you would need to advise your client to do is find a financial advisor who looks into DSTs to make sure that they've done their due diligence and they can help them find the best one for them. So once they've figured out what is the best DST for them, they want to find a fiduciary and, a registered representative who has their securities license, who does the due diligence on these DSTs. I have a few if anyone needs them that I trust. Once they figure out which one they want to go into, they will become a fractional owner of that larger portfolio. So they would own a portion of everything that is in the portfolio. So say there's 20 properties in it and one of them, stops paying rent. It's not really going to affect them that much because they've got 19 other properties that are still paying rent. And hopefully if it's a good DST and a good sponsor, they've put in something so that it's not really going to affect you too much. Something else to know about the DSTs is they can either be 2 years and help you go directly into a REIT, or they can be anywhere from 3 to 7 years where you're stuck in that DST for a certain amount of time, either 3 to 7 years, and then there's going to be an exit strategy. And upon that exit strategy, they can either go into another DST, cash out and pay taxes, reinvest in another real estate property, or hopefully they can upreit into a 720, they can 721 into a REIT if that's what they want to do. So it provides different options, but you want to make sure that they look at what the exit strategies are for each of those DSTs. So they're good as an initial investment option, but they're also really good as a backup option. If your client feels like they might not be able to find a good replacement property, a DST is a good alternative to make sure that they don't blow their exchange, because the DSTs have already been vetted by the sponsors. And as long as you find a good fiduciary who can go over the due diligence of each DST for your client, they should feel pretty comfortable going into that. Again, it's a security, so there's no guarantee of anything, but they do offer memorandums, private placement memorandums that basically break out each DST as much as possible so that they understand what they're signing on for. Holding period. Say your client purchases a property and they're like, okay, so I think I want to sell this soon. How long do I need to keep it? Technically, there is no holding period. The main thing is you need to be able to show what your intention is to the IRS. What is the intent? So your client or yourself, when you're purchasing your investment property, it's important that it's clear with you and your CPA that if you were to get audited, that you could show the IRS that your intent for this property was to have it for a long-term investment property. Sometimes people's circumstances change. A family member could get sick. Someone could lose a job. There might be, it might be a happy thing, like there's going to be a baby and we need to, kind of get rid of this so we can expand our house or change this into something else, or we need to move to be closer to family. There's different reasons why people might want to exchange sooner than later. So again, taxpayers' intent is the key. The more conservative perspective on this is you should hold the property for a minimum of 24 months or more. There is a private letter ruling that the IRS stated that a minimum holding period of 2 years would be sufficient. Technically, there is no holding period, but this is a conservative way to just make sure that you're indicating to the IRS that it was being held for investment purposes, and that was your intent. So that's what we would normally suggest if possible. If they decide to sell sooner, we would still try to suggest that you hold it for a minimum of 12 months and that it straddles 2 tax filing years to make sure they've had the opportunity to pay taxes on that property. Now, I have a client recently, he purchased a property a little while ago for $350,000, and 8 months later, somebody came to him. He was planning on building on it. He was working with getting building permits and stuff like that, but nothing had happened yet. And someone came to him and offered him $950,000 for that same property. He thought, okay, this is a good reason to sell. And his CPA and everybody else agreed that he was able to show, with the fact that he purchased the property, he was lining up contractors, he was trying to get plans drawn up, that he's showing he was getting it ready to create this as an investment property. But then an opportunity came by that was too good to pass up. So even only holding it for 8 months, he decided to do his 1031 exchange. Okay, so from the things I was talking about earlier, sometimes people are looking at something and they're thinking, I want to take my rental and I want to turn it to my residential eventually. You can do that, but you do need to make sure that you're doing it accordingly. So this is something that did happen a while ago. A California realtor did an exchange of her own property. RQ means relinquished property. So that's her investment property that she's selling. Okay. And she required a residence as a replacement property. The replacement property was also supposed to be a rental property. She ended up using it as her primary residence, but she reported it differently. She obtained an owner-occupied loan on the replacement property. She falsely reported her primary residence as a rental property and falsely reported her rental income to cover her tax. She also listed another rental as her residence address on her tax return. It ended up that she pled guilty to tax evasion and did 14 months in prison. So we want to make sure that we really do follow these tax codes and are being compliant and not trying to skirt things and, again, kind of cheat the system. It's a pretty great system. It has a lot of nuances. It allows for a lot of things. But again, we want to make sure that we're following all the rules for the 1031 exchange, because as you can see, it can have some consequences if they're not followed correctly and if they're trying to skirt around them. So converting a rental into a residence. Single taxpayer, they have the rental for 4 years, then they move into it for 2. So they had the rental, they're now living in the rental. They're going to have capital gains tax of $300,000. They're going to sell this property again. So they no longer get to use the full 121 tax exclusion because it was partially rental and partially, sorry, my dog is trying to get out. I apologize. I'll be right back. He's going to bark if I don't let him out. Okay. So as you can see, 4 out of the 6 years, or $200,000, is not eligible for that primary residence exclusion. So they're going to take a fraction of how long they've had it as rental and how long they've had it as primary. So when they go to sell it, they get a fractional amount, a fractional allowance for that 121 exclusion should they decide to sell the property in the future. Now, if they move into the property and they're not going to be selling it, they move into it as a primary residence, that's not a taxable event. So they will have deferred their taxes completely if that's something they decide to do, and that's going to be their forever home. Okay, so let's understand a little bit about the exchange equation. What does that work? How do you get full tax deferral? What does that look like? And what is partial tax deferral and allows for boot? So your client is selling their property for $900,000. They have $300,000 debt on that property. And the cost of the sale, that means commission and closing costs, is about $60,000. So at the end of the day, minus the debt and minus the cost of sale, closing costs and commissions, they're going to have $540,000 left over. For a full tax deferral, they're going to want to reinvest that net equity, which is $540,000. And they're also going to need to replace that debt. Otherwise, that debt can be subject to capital gains taxes. So as you can see, they're purchasing a higher value property, one for 1.2. And what they've done is they've increased their debt up to $660,000. And over to the right, boot. What boot means is any either net proceeds or debt that is not reinvested into the replacement property is called boot. And that boot is subject to capital gains taxes. I have looked things up to try and understand why it's called boot. I don't know. I haven't found anything. Maybe it's just because the capital gains will kick you in the butt. And so they call it boot. But it's called boot nevertheless. And any boot will be subject to capital gains taxes. Debt is called mortgage boot. Net equity is called cash boot. So these people, full tax deferral, good for them. And I just didn't get to the second one. Okay. There we go. Reinvest all net exchange proceeds and acquire a property with the same or greater debt to allow for full tax deferral. Now, in this one, they're going to step down a little bit in the replacement property. So there's going to be some boot. This is allowable. You don't have to do all of your funds, but anything you don't reinvest is going to be subject to capital gains. So here, they sold their property for $900,000. $300,000 worth of debt, $60,000 in costs of sale. Again, you've got that $540,000 of net equity, cash that they've got out of the sale. They're choosing to keep $100,000 cash on that. Okay. So they're reinvesting $440,000. They're going back and they're going to do debt, but they're only going to do $260,000 of debt. And the replacement property is $700,000. So you see over on the right, there's $40,000 of mortgage boot, and there is $100,000 of cash boot, and that $60,000 is excluded. That does not need to be reinvested, so that's a good thing for them. They don't have to pay any capital gains tax on the cost of sale. So the boot that they've got left over is, sorry about that, is $140,000. So now we've got another one here. $900,000. Their replacement property is going to be $800,000. $300,000 debt, $60,000 cost. They're reinvesting all of their cash. They are not reinvesting all of their debt. They're only going to get $260,000 in debt. So they've only got $40,000 of boot. And you can see that cost of sale actually helps us out in that point because we only have to pay taxes on that $40,000. The rest of it is excluded. It was a cost of sale anyway. It's nice that you don't have to pay capital gains tax for not reinvesting your cost of sale. So that is something that's a little bit helpful. But again, that's referred to as mortgage boot. And this is really important because lots of clients get it confused and they think, oh, I only need to reinvest whatever I get out of it. So as you can see from these three examples I've shown you, it's not just what they get out. It's the full value of whatever they received for the property when they sold it, minus cost of sale, being commission and closing costs. Okay. Some of the steps you guys want to take prior to the exchange. Have your client always go to their CPA and make sure that it pencils out to do a 1031 exchange. Sometimes people will call me up, hey, I purchased this property 2 years ago. I'm going to be selling it. I want to do an exchange. Well, has it gone up that much in value? No, not really, not that much. So what do you think your capital gains are? Oh, I don't really know. Okay. circle with your CPA, because if your capital gains are not extensive, you might really not have that much to pay in taxes. You don't really want to stick yourself in the confines of a 1031 exchange if you don't need to. So they always want to check with their CPA, find out what their tax basis is, and see if it's even worth doing a 1031 exchange. So their capital gains are going to be minimum, then there's no need to do a 1031 exchange. On our website, we've got a capital gains tax calculator that will help them figure that out. They want to kind of get an idea prior to going to their CPA. Once they've decided that they need to do a 1031 exchange, they want to consult a qualified intermediary, someone such as myself, to walk them through the process, explain all of the rules to them, make sure that they understand what they're going towards and what the benefits of it are. Confirm who the taxpayer is that owns the property. Some people are not sure if it's in a trust or an LLC. They don't really know who pays the taxes. Some people own multiple properties. They don't pay that much attention. So you might want to check with an attorney or an estate planner to figure out who the taxpayer is. So we make sure that that's in order. And then you want to confirm that the purchase agreement matches the title and tax ownership. Okay, so we're going to talk a little bit about the regular delayed exchange. So the taxpayer, that's your seller, okay? They are going to sell their property. When their escrow closes on their sale, they're now going to become the buyer, okay? And when escrow closes, we are going to take the proceeds from that purchase and hold on to them for your client while they are looking for their replacement property. So the funds are going to go from the buyer of their property to us. We're going to hold those. We're basically a second escrow. Okay, so once escrow closes on their sale property, they're going to have 45 days to identify their replacement property. Now, during that 45 days, they can look at property, they can put offers in, they can do whatever they want. They don't need to tell us anything until when you get closer to the 45 days. Whatever they have on their list by midnight of the 45th day is the only thing they're allowed to close on. So it's 45 days from close of escrow of their sale to identify a property and 180 days from close of sale to close on that replacement property. And again, the identification needs to be done prior to close of escrow midnight 45 days after close of escrow. And your exchange needs to be set up prior to close of escrow because we need to get the exchange documents out to your client prior to close of escrow. So I usually recommend the minute you go under contract on their sale, you get me on the phone, I set up their exchange documents, they're all in order. That way, if anything changes with closing, say all of a sudden it closes early, we've got everything in place so that they don't blow their exchange. If their escrow closes on their sale and they have not set up their exchange, they are not eligible to do an exchange anymore. So these are the identification rules. There's 3 different rules. The one that's most commonly used is what's called the 3 property rule. So during that identification period, these are the rules that they need to follow. And we're going to send them an identification document that has these written out so that they remember what they're doing. So first, there's a 3 property rule. So the taxpayer may identify up to 3 properties of any fair market value. So any value is the main thing you want to notice with that one. 3 properties, any value. The second one is called the 200% rule. The taxpayer may identify an unlimited number of properties, provided the total fair market value of all properties identified does not exceed 200% of the fair market value of the relinquished property. So say the property that they sold is for $1 million and they want to identify 5 properties. The most they can identify with those 5 properties is $2 million. Okay, so there's a limit if they want to identify more than 3. If they only identify 3, they can be of any value. So that's important to know. Now, if they want to identify more than 3 properties, and they want them to be of any value, there's the 95% rule, which is a little more difficult to comply with. So again, if the taxpayer identifies properties in excess of both of the above rules, then the taxpayer must acquire 95% of the value of all properties identified. So basically, everything they identified, they have to close on, because it's pretty tough to like, that little 5% that's left over is kind of it. I don't even know why that rule's there, really. It's not one that most people use unless they pretty much are guaranteed that they're going to close on whatever they identified prior to the identification date. Okay. Now, when they're identifying these properties, they must be made in writing and signed. So we're going to send them an identification document. They'll put their identified properties on it, and they're going to sign it and scan it back to us. Or you as a realtor can take that document, put the addresses or APN numbers in for them and send it to them for DocuSign. But there needs to be some type of either wet signature or electronic signature attached to that document. They can't just send an email saying, hey, Stephanie, I identified these 3 properties. Thanks, bye. It has to be done in writing and signed. Unambiguously describe the property. So again, that means like an actual address or an APN number. There needs to be no question of what they are identifying. So you never want to have them wait until the very last minute to identify, because you want a day or two to go over and make sure that they identified the right property. Even if they identified the wrong suite number, that could blow their exchange. So we want to make sure that whatever they identified, that the numbers are in the right order, the suite is in there, that the APN numbers are syncing up. Again, needs to be hand-delivered, mailed, telecopied, which means faxed, or otherwise sent, which today would mean emailed. This is just the actual language of the tax code. So that's what that is. If they wanted to walk it in, which they don't usually, they can do. And again, it needs to be sent by the midnight of the 45th day and delivered to the qualified intermediary or party related to the exchange who is not a disqualified person. That's a whole other ballgame. It's part of the rule. I'm just putting it out there, but easiest, just make sure it gets to your QI prior to midnight of the 45th day. These are the identification rules. And as you can see, we send it out to your clients. It's got the 3 rules on it so they understand. And it's also got a place where they can check which rule they're using, as well as identify those properties. Now you'll notice it says on the right-hand side, percent interest in a property. Sometimes they might be purchasing a triplex and maybe they're going to live in one part of it and the other part is going towards the other 2 that are going to be used as rentals. So that one would be, you know, like say 75% of that property was going to be used as investment property. So they'd have a 75% interest in that property for the 1031 exchange. The other part they'd be using as primary. There's different types of scenarios with that, where part of the property might be residential, or maybe they're going into this purchase with someone else and they're only acquiring a 50% undivided interest in that property. So we make sure that that's clear too, so that there's no ambiguity in that at a later date. So multiple properties. They can sell, say they're going to sell 3 single family residences, and then they are going to purchase a CVS because they just don't want to deal with the tenants, trash, and termites anymore. They'd rather get something that's a triple net retail net lease where they don't have any management except for maybe sending an inspector out once a year. And then they're going to get that money in with a nice long-term lease so they can kind of sit back. Less management, more money, hopefully, how that turned out. So they've got 3 properties that they're selling. When escrow closes on that first sale, that is the date that their 45-day identification period begins. So you as a realtor want to make sure that you're paying attention to that date, because you want to probably try and have a longer close of escrow date for that first one. And then the next 2, you want to kind of get them as close to that first close of escrow date as possible. or possibly even write in some options to extend, because you want to allow your seller, your client, your taxpayer to have as much of an identification period as possible so that they can make sure to find a replacement for those properties. Again, the identification period starts at the close of escrow from the first sale of those 3 properties. And again, they've got the 45 days to purchase and the 180 days to close. Now, it can go the other way as well. If they are selling the property, they're going to sell 1 and they're going to identify 3. So they need to identify those 3 properties within that 45-day period, and they need to close on them within the 180 days. Okay, with a reverse exchange, this is something that's different. It's parking the replacement property. So the good things about this is the exchange equity does not need to be present and allows for multiple relinquished properties. The negatives is the lender may have issues lending to the exchange accommodation title holder. Okay, so what happens with a reverse exchange is your client is going to put an offer in on a property. Okay, and sorry about that. Their offer gets accepted. So their property's on the market, but it hasn't sold yet. They come across this property that they love. They want to get it because it's going to go in 10 days and they don't want to miss out. So their option then is to do what's called a reverse exchange, where they purchase their replacement property prior to selling their property. So they're going to put their offer in, they get accepted, then we step in as what's called an exchange accommodation title holder. Again, exchange accommodation title holder, also referred to in short as an EAT. So the offer's been accepted. As due diligence is going and things like that, we are going to notify the seller of that property that they're going to be assigning the purchase over to us. And we are basically going to own that property in title only until the seller sells their relinquished property. During the time that we are title holder on that, we in essence lease it back to the owner. So they can lease it out, they can do improvements, they can do whatever they need to do while we're holding that title, while they are in process of selling their property. So if they have multiple properties that they might be considering selling, the same thing applies. They have 45 days to identify what property they're going to sell and 180 days to close on selling that property. So some of the things, when they're looking at doing a reverse exchange, there's a few lenders that will do reverse exchanges, but they want to search one out prior to putting their offer in, unless they are capable of doing an all cash offer. Either they've got the cash on them or they can pull funds from other properties that they own. Those are usually the easiest things to do. There are quite a few reverse lenders out there, but you want to make sure that they look into that because they're regular lenders like Chase, Bank of America, those types are most likely not going to do a reverse exchange lender. Because what happens in essence is your client is funding the purchase. They are the guarantor of the purchase, but we're going to be owning the property for a certain amount of time. We're purchasing the property, but with their funds, and they're going to be the guarantor. Okay, so once they have found their replacement property, once they've sold their property, their relinquished property, those funds are then going to come to the exchange accommodation title holder to us, and then we are going to give the funds back to your seller so that they can pay off whatever the debt or replace the cash that they took out to do the replacement purchase. Can a 1031 exchange be set up last minute? Yes. As long as you have not closed escrow on your property, we need usually a couple hours to a day to get exchange documents out. If it's a rush, we can do it on the same day. We would like at least a day advance. But again, just so we're not under the gun at the last minute and blowing the exchange, I always suggest the minute your client goes under contract on the sale of the property, you give us a call. We get the exchange documents set up. We contact the escrow officer to get title and the purchase agreement so that we can set up those exchange documents. We get them out to your clients. I explain all the rules just like I have with you, but much shorter. And then we can get those set up. Again, if you've closed escrow on your sale, they are no longer allowed to do the 1031 exchange. So again, if it's last minute, you need to stop the closing. Call your escrow officer. Do not sign off on the close. Contact the 1031 exchange qualified intermediary, and we will get those documents out to you as soon as possible to be signed. And here's some information about my company for social media purposes. Here's my contact information. And you guys were quite a quiet bunch today. I usually have a lot more questions, hands up during the whole thing. But if you have any questions now, I'm happy to answer those for you. I don't know if you were taking notes or anything, but.
You want to unshare your screen then, Stephanie?
Yeah. Oops. Okay. Stop share.
And then I will also get your information out to everybody. You know, I had a couple of ahas on this. Number one, it appears as though that there are quite a few options for like properties. And so there's opportunities to, you know, explore so many of these different things. The other thing is the importance of making sure you contact your CPA first and foremost, you know, before you move forward with anything. And then jump in and ask questions with companies like yourself to get a better handle on the type of 1031 exchange that can be done.
Yeah, and I do a free consultation. You or your clients can call me anytime. If I don't answer the phone, it's because I'm doing a presentation like this out somewhere, and I will always get back to them, if not that same day, like as early as possible the next day.
Yeah. And then the other thing is the importance of having an exit strategy for whatever you want to do.
If it's ESP, yeah.
Do we have anybody has any questions that they'd like to ask? Nobody? Oh, wow.
I explained it all really, really well.
Yeah. We will send a link out to you with this recording if you want to revisit it again. And I'll also send out information regarding Stephanie's contact information in the company. I do appreciate you taking the time to explain this. I know I learned some things. I was really blown away, though, that you have to pay taxes on depreciation. That was a new one. That was a new one for me.
Recapture tax.
Yeah, super. Okay, well, if there are no other questions, we'll just end this. And we're going to have another webinar coming up next month. And this one's going to be a little bit different, but it's kind of a sidebar to 1031 exchanges. And that is an exit strategy for those that may sell a primary home or an investment property or a business, anything for that matter, and they want to keep the money, but they don't want to pay all the capital gains at one point in time. So I'll give you an example. So if you bought your home for, let's say, $400,000 and you sold it for $2 million. If you're single, you get $250,000, and if you're married, you get $500,000 to deduct. The remaining amount would be capital. You'd have to pay capital gains taxes on that. But there is a structured annuity payment plan out there where you could take those funds directly from your escrow and put it into this annuity, and then take out the funds slowly. So let's say you're taking out $5,000 a month, $60,000 for the year. Now you're paying capital gains only on $60,000. So that's we're going to be talking about that next month as another option for those people who have purchased their homes, especially their homes, at low prices, and now they've escalated, and now they don't want to have to pay the taxes on it. And that's another reason why people aren't selling their homes, because they don't want to pay capital gains. So look forward to that one next month. Stephanie, Kelsey, I appreciate your time today, and thanks everybody for showing up. Have a great day.
Thank you so much for having me here, and thank you to everybody for all of that. And I really appreciate you showing up today.
Thank you.
Thank you, Keller.
Thank you.
Stay cool.